Hi there, and welcome back to our Finance 101 series. I got Lisa Kirchenbauer here with me again. Today we're going to be talking about judging the performance of your portfolio. We've been getting more and more questions about the S&P 500 versus the results some of our clients are seeing. So Lisa, talk about why that might not be the best idea.
Well, I think it's a challenge anytime when you're comparing what is normally a well-diversified investment account, let's say, against one index. The S&P 500, Standard & Poor's 500 is 500 of the largest stocks. It's only U.S., it's not international. And for most, I think, investors and clients, the idea of just being invested in the S&P 500 is a little too rocky of a ride. It feels good when it's on the upside, but when it's on the downside, not so fun. And but sometimes it's hard to remember that you've got a diversified portfolio because you look at the news and you read the paper and you think, hey, I want that.
Right. So having a diversified portfolio is important to us, and we'll talk about that in another blog, the importance of having bonds in your portfolio. But can you talk about maybe the frustration you might feel when you're looking at the S&P 500 or the Dow in the news and you're seeing it's at 8% and my portfolio is only at 5%. What's behind that? Why can't my portfolio keep up with that, with
Right.
those benchmarks?
So when you actually break it down, so if for most of our clients, if they can go look at their investment statements and they can see that they're not 100% in large company U.S. stocks, you can start to imagine that perhaps, all right, if the S&P 500 is at 8% and I'm not invested fully in the S&P 500, I'm going to have a different return.
Right.
Sometimes it can be better because you've got international stocks and they're having a great year, more like last year. Other years, you're just going to have lower returns. But there are some benefits and trade-offs to that. And I think the key becomes, as we like to talk about it on the goals-based investing side, is what return do you need?
Right.
Do you need to take that much risk? Most of our clients either don't need to or really wouldn't be comfortable taking the kind of risk to get those returns that you see if you're 100% invested in that stock index.
Right. And one of the things that we like to do here when we're looking at putting a client in a different portfolio is go back and look at the results that strategy had in 2008, 2009. That was 9 years ago by now. So
it's a distant memory for most people, right?
Yes.
And when what you see and what you hear is that it seems like it's been just an upward trajectory. What we both know is that, in fact, there have been some years since 2009 that haven't been very great for stocks or bonds or international stocks or anything. But it's important to go back and understand, if the more aggressive I'm going to be, what would that have been like in 2008, 2009? And sometimes we find clients make different choices as a result because they can't really stomach that downside risk. And you got to think about that. It's not, you don't just get to have the upside without the downside. That's how investing works, is that the risk and reward, right?
Right. So to wrap things up, is there an answer out there for how clients should measure their performance on their portfolios?
Well, I think being able to look at, depending on the kind of statements you get, certainly the ones we get from SEI, do show some different indices. They show the different returns of the different, like, stocks versus bonds and international and emerging markets. Being able to look at that more completely as opposed to just in that bubble of the S&P 500 index.
Absolutely. So hopefully that was informative for all of you out there. We appreciate you watching. Again, if you have any questions, reach out to us directly, or if you have any comments, feel free to comment below. Thanks.
Okay.